everyone. Good afternoon. Thank you for joining. So today we're going to take a deep dive into ESG funds, so my favorite topic. And we're going to use assets and flows to paint a little picture of market direction, sort of answer the question, is money still going to ESG? Where is it going? And then we're going to look at companies most held in ESG funds and what that tells us about managers' preferences. So in other words, is it the E that people care about? Is it the S or the G that really matters to fund inclusion? Now, before I dig in, just maybe a quick introduction. So I cover ESG for Bloomberg Intelligence, which is Bloomberg's research team. So I describe my job as sort of taking Bloomberg's ESG data and providing analysis into it. So writing about trends, drivers in climate, gender, and basically how our clients can use this data when they're making decisions. So let's dig straight in. Over here, we see assets for ESG ETFs. Now, first, this is ETFs, so exchange-traded funds, or one slice of the fund pie. But I think in terms of trajectory, in terms of growth, risks, and opportunities, this is pretty indicative of the market overall, just the trajectory. Now, what you'll see here is that assets have reached about 500 billion globally. You can see that the orange bar, or the US, is about 25% of global assets, approximately. So it's very clear that the dominant player is really Europe, which is pretty much the rest, like the white bar. And we think that dominance of Europe is only going to continue. Now, assets is comprised of really market appreciation and also flows. So a lot of this trend is actually driven by market appreciation. You can see sort of the bull markets from 2015 to 2021, and then a bit of a slowdown. And I think a better sort of indication of market sentiment is just flows. So in other words, just inflows and outflows from ESG funds. And that's what you see in this next slide over here. So you can see that flows they peaked in about 2021. A lot of it was driven by clean energy, actually, which has sort of come down off its highs. What's interesting, though, again, is that the yellow bar, which is the US, if you look at 1H 2023, that's gone into negative territory for one of the first times, actually probably the first time. Now, how many people think that negative flows is the backlash in the US? Just a quick raise of hands. Okay, not too many. I don't think it's really the backlash. So if we look at what really drove those outflows, it's one fund. One fund saw 7 billion in outflows, and that's it. I mean, other funds saw outflows, but that is largely driven by one fund. And that, to me, points to concentration risk. It's not like there's this mass uprising where multiple funds are selling ESG, right? It's really one fund. And the challenge there is that assets have grown historically due to these large allocations from a couple of investors, making us very dependent on a handful of investors and a handful of funds. And when something like this happens, one flow comes out of one fund, it just ends up being very noticeable. So again, not this mass uprising against ESG, it's really just one fund. And I'll just throw out another statistic. So the US ESG ETF asset base, 30% of it is held by 11 investors. So when you're dependent on 11 investors on their whims and fancies, you face a lot of concentration risk. So what we really need today is a wider investor base. We need to move beyond just those 11 investors to retail or to other investor classes. And that's where I think the backlash is going to come in and challenge things. In other words, we're going to create a pause or sort of a challenge in the widening of that investor base, because people are now, they're just scared of investing in ESG. So that's really my view, that these negative flows is not really driven by some kind of backlash, but the backlash is going to stop the more positive flows from coming in, widening of the investor base. So I want to switch gears a little bit and talk about companies most and least held by ESG funds. And the reason we did this is because everybody knows that when it comes to ESG ratings, they differ. So what we did is we looked at companies most held in ESG funds. In other words, what companies are the most preferred according to fund managers, according to fund managers' highest convictions. So to the left, you can see our high conviction portfolio, in other words, companies most preferred. And to the right, you can see our exclusions, or in other words, companies that make it to none of the ESG funds that we analyzed. Just a quick word on methodology. So we took the 15 largest ESG funds in the US, and we looked at how frequently is a company held and how overweight is it held in these funds to define that conviction score, which really sort of defines high conviction versus low conviction. It ranges from 0 to 2, with 2 being better. The one thing you'll notice here is that a high conviction portfolio, so the one to the, that's my right, yep, the one to the right, a lot of it is driven by resource-light sectors, right? Technology, financials, healthcare. And that tells me that ESG investors tend to prefer resource-light sectors. To the right, if you look at our exclusions portfolio, you'll see a lot of the resource-intensive sectors. You'll see utilities. In fact, about 66% of the S&P utility constituents are in no ESG fund we analyzed. Now, if you roll this up and you look at just the average relative weighting to the S&P, you see exactly the same thing. Information technology is about 2% overweight, energy about 3% underweight, and utilities underweight again. Now, that to me tells me that ESG investors tend to prefer resource-light sectors, in my mind, giving them a bit of a free pass while avoiding the resource-intensive sectors, creating, in my mind, multiple missed opportunities. So we've identified, and we'll come to this later, but we've identified many companies that have ambitious carbon reduction goals. They have good environmental, social governance scores, but they're simply left out of these funds because they're in utilities, cement, or steel, or airlines. And that, to me, again, many missed opportunities. So if we examine the ESG characteristics of these, the most held versus least held companies, what does that tell us about what managers prefer? It tells us that ESG fund managers prefer the E above all S, overlooking the S, the G, again, creating multiple overlooked risks. So if we look at this chart, you'll see that to the left, the median environmental score of our high conviction portfolio, and in other words, companies most held, is much higher than the exclusions. That means a better environmental score means you're in more ESG funds. You don't see that really for the S and the G. That means that a company in an ESG fund has not really different governance than one not in an ESG fund, suggesting it doesn't matter. Now, most counterintuitive thing I've heard in my life as an ESG analyst, but that's what it suggests. Again, what we have here is a focus on the E, creating multiple overlooked risks on the G. And we can see that a little deeper on this slide, where I've selected companies to the top, which are in many ESG funds. So they have a high conviction score, but they have poor governance across multiple rating providers, sort of like a consensus on poor governance. I mean, case in point is just Tesla. Tesla, highly debatable, ESG, not ESG, we can talk for hours. But at the end of the day, fund managers consider it quite a high conviction stock. Many funds hold Tesla. But very bad governance. Again, multiple overlooked risks. And to the bottom, you have missed opportunities. So these are companies not in any ESG fund. They have a low conviction score, but they have good governance. Case in point, AES. AES is an American utility. They're in no ESG fund we analyze. Good governance. I don't have it here in the slide, but very ambitious carbon reduction goals. But still, not in any ESG fund, probably because it's in the utility sector and has a high carbon intensity today. So again, multiple missed opportunities and overlooked risks. And that's all I have for today. Again, we looked at assets and flows. We said, we need a wider investor base when it comes to ESG. And then we examined some of these fund holdings. And the consensus is really that investors prefer these resource-light sectors. They prefer the E, in my mind, creating many, many missed opportunities and overlooked risks. That's all I have for you today. Thank you.